Let me tell you something that changed everything for me. The year was 1907. I was 30 years old. By that time, I had already made fortunes and lost them more times than I care to count. The market was unstable. Credit was tightening. Banks were trembling. And I sensed it, not in a mystical way, not because of secret information, but because I had slowly and painfully trained myself to read what the market was truly saying instead of what I wished it would say. I took a short position. I held it as the market unraveled around me. When October arrived, panic struck with full force. Most men were completely wiped out. I walked away with roughly $3 million. I am not telling you this to impress you. I have gone broke more times than most people ever succeed. I lost it all again after that, and then again. The lesson is not about the money. The lesson is this. Every trader I knew at that time was watching the same market I was watching. They had the same information. They could read the ticker tape. Many had more experience than I did, yet they were either on the wrong side or not in the trade at all because they had exhausted themselves on dozens of small moves before the real opportunity appeared. The difference between us was not intelligence. It was not talent. It was the way we interpreted what the market was showing us. That is what I want to discuss. When I was young, barely a teenager, working in a bucket shop in Boston and watching the ticker tape roll by, I believed price movement was the market itself. I believed that when something moved quickly, that was where the opportunity lived. If a stock jumped 10 points in a day, I wanted in. If something fell sharply, I wanted to short it immediately. I was not alone. Every trader around me thought the same way. We chased movement. We believed speed meant significance. And for a while, in the bucket shops, it seemed to work. But that was because in a bucket shop, you were not truly trading the market. You were simply betting on short-term price swings. And short-term price swings are noise. They are meaningless. The bucket shop profits from the spread regardless of whether you win or lose a single trade. I could be correct often enough on minor moves to convince myself I understood something. Then I stepped into the real market and was repeatedly destroyed because I was still reading it the same way. I was still chasing movement. I was still confusing noise with signal. Here is what I had to learn, and it took years of losses before I fully accepted it. Most price movement is not the market speaking. It is the market breathing. It is normal fluctuation. It is the daily randomness of buyers and sellers who share no unified purpose. It is noise. The true message, the structural message, lies beneath all of that. To read it, you must stop reacting to every tick. You must stop treating every fast candle as an invitation. The amateur looks at a chart and sees motion. The professional looks at the same chart and asks a different question. Does this movement matter? Is the tape telling me something real? Or is it creating an illusion meant to lure weak hands into a poor position? Because that is what the market does. It creates illusions, not because it is alive or plotting against you, but because human nature inside the market consistently produces patterns that fool the undisciplined. And those undisciplined traders provide the fuel for genuine moves. Let me admit something openly. In my early years, I traded too frequently because it felt satisfying, not because it was profitable. Placing a trade creates a sense of involvement, a sense that you are doing something, that you are alive in the market. When nothing is happening, and you are sitting in cash, that absence feels uncomfortable. I have seen intelligent, capable traders destroy their accounts not because they misread the market's direction, but because they could not endure the discomfort of inactivity. So they traded. They invented small reasons to justify entries. They convinced themselves they were being active and strategic. In reality, they were trading their boredom. This is an essential distinction. Trading to escape the discomfort of doing nothing is not trading. It is using the market to feel something. And when you trade for emotion, you are not thinking clearly. You are not interpreting the chart. You are projecting onto it. The chart becomes a reflection of your anxiety. When you want to be in, you see reasons to enter. When you are already in and afraid, you see reasons to exit prematurely. After sitting in cash for 2 weeks and feeling left out, the next small move appears to be the opportunity you have been waiting for. But it is not. It is impatience making the decision that discipline should make, This weakness cost me enormous sums over my career, not ignorance, not flawed analysis, impatience, the inability to sit calmly while nothing happened. The trader who survives long enough to compound real wealth learns that boredom is not the enemy. Boredom is the environment in which he does his best work. He waits, he watches, he preserves his strength, and when the true opportunity arrives, he is prepared. People often repeat something I once said. The big money is not in the buying or the selling, but in the waiting. Many nod as if they understand, then return to watching 1-minute candles and hunting for constant entries, doing precisely what the quote warns against. So let me clarify. The substantial profits in the market do not come from frequent trading. They do not come from cleverness across 10 minor trades. They come from identifying the primary trend, positioning correctly within it, and possessing the discipline to hold through the noise that attempts to shake you out before the move concludes. Waiting is not passive laziness, it is active restraint. It is seeing a small pullback within a major trend and choosing not to react. It is watching price fluctuate near an important level for 2 weeks and deciding that the noise does not alter your structural view. It is holding a profitable position, while every instinct urges you to take profits early. Waiting is the hardest part of trading because human nature does not prepare us for it. We are wired to act. We are wired to respond to movement. A sudden drop feels like a threat, and every instinct urges you to escape. But if your broader analysis is correct, if the trend is intact, if the underlying conditions that created the move remain in place, then the pullback is not a signal to exit. It is a test of conviction. The traders who achieve substantial gains are those who endure that test. They remain steady through the noise because they understand the structure. They do not mistake temporary fluctuation for a reversal. Waiting means tolerating discomfort that is not genuine danger. When I read a market, I was not interested in short-term moves for their own sake. I wanted to know whether those moves confirmed or contradicted the broader structural narrative. Before entering any trade, I needed clarity on the primary trend, not the daily movement, not what happened this morning. The real trend is the market rising over time, falling, or biasing, moving sideways and building pressure for something larger. That question outweighs all others. Once the trend is identified, smaller moves gain meaning. A minor decline within a bull market is a pause. A minor rally within a bear market is a temporary bounce. Without awareness of the trend, each move appears independent. With context, its meaning becomes clear. This understanding allowed me to profit in 1929 when many others could not. The warning signs of the bear market were visible long before the crash. Weakness was evident to anyone not determined to remain bullish. By October, I had built my short position gradually over months. I was not reacting to the crash. I was positioned in advance because I had read the structure. The amateur sells on the crash day and calls himself clever. The professional was prepared long before. The crash simply confirmed what the structure had already revealed. This is why confirmation is vital. I do not enter based on feelings. I wait for the market to validate my belief. If I think a stock is beginning a significant advance, I want to see it break a key level and hold. I want evidence. I would rather be slightly late and correct than early and wrong. Being slightly late to a genuine move is far superior to being early to a false one. Another lesson took me years to grasp. Discipline is a form of capital. Like money, it can be spent. Once depleted, nothing remains to trade with. Every unnecessary reaction to minor movement drains decision-making energy. Throughout a trading day, constant reactions to every tick and spike leave you exhausted. Then, when the true opportunity appears, you have nothing left. You are tired. Your thinking is clouded. You either miss the opportunity, enter poorly, or manage it badly because you lack emotional reserves to withstand drawdown. Professionals protect their attention carefully. I did not stare at the ticker all day. I reserved my best thinking for moments that warranted it. The amateur treats the market as a conversation, demanding constant participation. He fears missing out. But the market is not a conversation. It is a gradual revelation. Most daily movement is irrelevant to your objective. Way was. Issues to capture major structural moves. and those do not appear daily or weekly. Sometimes months pass without one. During such periods, the correct action is inaction, preserve capital, preserve mental energy, stay ready. A trader who remains inactive for 6 weeks and then executes a precise entry on a major structural move is far ahead of the trader who trades daily and reaches the major opportunity, exhausted, overtraded, and financially weakened by small losses. This sounds simple, yet few truly accept it. The market does not know you exist. It does not care about your analysis or your financial needs. It does not adjust to ensure your success. It moves according to the collective actions of all participants, most of whom are unaware of your position. Still, I have seen experienced men behave as if the market targeted them personally, as if it waited for their entry before moving against them. This mindset is dangerous because it removes responsibility. When I broke my own rules, and I did so more than once at great cost, I did not blame the market. I blamed myself. The rules existed to protect me from my worst impulses. When I abandoned them, I was not a victim of the market. I was suffering the consequences of my own indiscipline. There is clarity in fully accepting this. When the market behaves differently than expected, ask 2 questions. First, was my structural interpretation correct? And has that structure changed? Second, ask yourself 1 question after every trade. Did I follow my rules? If you followed your rules, and the trade still resulted in a loss, that is a completely acceptable outcome. You do not control the market. You only control your process. A loss taken according to plan is not failure. It is simply the cost of operating in a business built on uncertainty. But if you violated your rules, if you held a losing position beyond your stop because you hoped it would come back, if you averaged down because you refused to accept being wrong, if you cut a winning trade short because you were afraid of giving back profit, that is failure. Not the market's failure, yours. The market owes you nothing. It provides opportunity, nothing more. It gives you a chance to interpret structure correctly and profit from that interpretation. But it gives no guarantees. In exchange, it demands honesty and self-control. When you can look at a losing trade and calmly say, that was the best decision I could make with the information available. Or admit, I broke my rules and I will correct that behavior. You begin to think like a professional. There is something uncomfortable that must be acknowledged. Fear and hope are not rare in trading. They exist almost constantly. While you are in a position, they quietly influence how you read price action. They shape what you see on the chart. When fear takes over, every small pullback looks catastrophic. Every minor lower high feels like proof that collapse is coming. Your mind, trying to protect you from loss, constructs a narrative that justifies exiting immediately. It convinces you that structure has shifted, that the trade is no longer valid. Yet nothing external has changed. Only your emotional state has shifted. And because your mind looks for evidence that supports your fear, it always finds something. Hope operates in reverse. When you are trapped in a losing trade and unwilling to accept defeat, hope begins to reinterpret the chart. A small bounce becomes the beginning of recovery. Sideways movement becomes accumulation. Your mind shields you from the discomfort of realizing you were wrong by inventing reasons to stay. This is why discipline cannot be created in the heat of the moment. Once emotion is active, judgment is compromised. Real protection comes from decisions made before E. Motion enters the picture. A predefined rule, a structured plan, a fixed exit level that you respect, no matter how you feel when price reaches it. A professional does not manage trades emotionally. He manages them systematically. He defines risk before entry. He knows exactly where he will exit if wrong. He determines under what circumstances he will increase exposure to a winning trade. And when those moments arrive, he executes without negotiating with himself. Simplicity also matters. The more indicators, screens, and signals you monitor, the more opportunities you create for emotional overreaction. Each additional variable can trigger fear or hope. A clean process leads to clear thinking. Instead of drowning in indicators, ask direct questions. What is price communicating? Is it behaving as expected? Does the structure remain intact? If yes, hold. If no, exit and reassess. Now consider a principle that is often misunderstood: sitting tight. Sitting tight does not mean blind stubbornness. It does not mean ignoring new information. It does not mean believing every trade must eventually succeed. Sitting tight means recognizing the difference between temporary noise and genuine structural change, and refusing to act on noise. In a properly aligned trade, even one positioned within the primary trend, temporary instability will occur. Pullbacks happen. Consolidations form. At times, the position may look as though it is failing. Instinct urges you to exit and protect what remains, but if the broader structure remains intact, that instinct is misleading. It reacts to short-term fluctuations rather than meaningful change. Many traders lose their largest opportunities not because they entered poorly, but because they exited too early. They could not tolerate temporary discomfort. They abandoned correct positions, and then watched from the sidelines as the market fulfilled the iroriginal expectation. Sitting tight requires preparation. Before entering, you must understand what normal volatility looks like. You must accept in advance that doubt will appear. You must commit not to respond to that doubt unless structure itself breaks. Temporary rallies within a broader bear market, for example, are natural. They do not automatically signal the end of the larger decline. They often reflect hope among participants who want the trend to reverse. Understanding this allows you to tolerate short-term movement without abandoning the larger thesis prematurely. Significant profits from major structural moves rarely belong to the impatient trader. They belong to the one who correctly identifies the opportunity and possesses the discipline to remain through all the discomfort that precedes the full realization of the move. At its core, trading requires a shift in mindset. The amateur views trading as constant reaction. He believes success comes from speed, activity, and frequent engagement. He measures effort by the number of trades placed and hours spent watching charts. The professional views trading as disciplined restraint. He waits for meaningful moments and ignores countless irrelevant ones. He protects mental clarity and capital for opportunities that truly justify action. Boredom illustrates this difference. For the amateur, boredom feels like missing out. It creates anxiety and encourages impulsive trades. For the professional, boredom simply means conditions are not favorable. It is not a problem, it is patience in practice. High-quality opportunities do not appear every day, sometimes not even every week or month. During quiet periods, the professional observes and studies without forcing action. Not trading is not failure. It is discipline. It is respect for timing. When the proper alignment finally appears, when structure, confirmation, and risk parameters align, he acts decisively. Because he preserved his discipline during inactivity, he can commit with clarity when it matters. Fortunes in markets are not built on constant activity. They are built on correct structural interpretation, disciplined execution, and honest management when conditions change. Experience reinforces this lesson repeatedly. Every lapse in patience carries a cost. Every emotional reaction to noise carries a cost. Every decision driven by fear or hope, rather than plan, carries a cost. The market is not a place to prove ego or fight battles. It is not an arena for revenge trading or emotional validation. It is a place where structure must be interpreted correctly and then respected with patience. Excitement is not rewarded. Constant action is not rewarded. Emotional reactivity is not rewarded. What is rewarded is restraint, discipline, and the ability to act cleanly when true opportunity presents itself. That is the difference between activity and professionalism. The professional is not the fastest, not the most excited, not the most active. He is the most disciplined.